Chris.
Good day. This is the Eye of the Storm podcast with the big picture update for Sunday, May 14th, 2023. Today I'm going to be updating the SPX and the NDX, the 2-year note and the 30-year bond, gold, silver, and the dollar index. And I'm going to try to keep it all to under an hour. Beginning here with the SPX, it's still a pretty crazy week, and I'm starting here on the weekly chart. And because I want to show how basically that we are still within the finishing stages, but still within, starting at a top level, a primary B wave countertrend rally. And that started here at the October lows at approximately 34.91 was that low, 35.02 in the futures market. From that low, the market has been putting in a series of ABC counter-trend rallies. And within it, so we're looking at a primary B wave. What will be comprise that primary B wave will be an intermediate A, B, and that C wave that we are now in. Understanding that all C waves are 5-wave structures. So within that C wave, we've done minor wave 1, 2, 3, and 4. So we're still within this finishing stages, but through this entire process, excuse me, we have actually been stuck in a pretty tight range. If we can go back to December, that range was about 3,800. And then from there, it ran up to about 4,100. Then as the new year broke, we kind of increased that. So by mid-December, we were still 3,800, but we picked up the top side of that and took it up to 4,200. So from basically April, we have been stuck between 3,800 or 3,816-ish, right around in that area, up to 4,200, with a very strong draw or magnet still sitting around the area of 4,150. And that's including the SPX. So in the SPX, we could drive it down to 4,125, but it goes up 4,150, 4,100, up to 4,150. It's stuck in this range. Now, why would it be stuck if the market is just really trying to finish a counter trend rally? Obvious reason is there is many factors coming to light. And we're in between where it would feel like no one's really telling the truth. And what I mean by that is that we continue to have the battle with inflation. We continue to have a banking crisis brewing underneath all of this, even in the face of many of these banks telling us, oh, we're solvent, we're great, we're not having any problems, we're doing well. And so, of course, that then forces the short covering, forces what's being done in that stock to stop and for it to reverse. And then we get the conversation that the whole banking crisis is being really put to blame on short sellers. So we're asking for the SEC to now investigate those short sellers. We're also asking via the Senate and the banking committee that the SEC needs to take a look at insider sales within Silicon Valley Bank and the other two banks, the two large fails that have already taken place. This is just, for lack of a better word, folks, a sideshow. It's totally masking over the true, serious problem that still exists. Remember, I've also discussed that there are approximately $2.1 trillion at risk of loss because of bank failures. So this uneasiness remains as an underlying factor. Whether traders are going to catch the beef and the fault because they sell the stock short is not really what's underlying and underneath all of the problems. It continues to just be truly bad trading on the part of the banks in taking their deposits and placing them in longer term strategies with treasuries. Buying, for example, a 10-year note and expecting to hold it to maturity to get that interest to then pay out to those depositors in terms of dividends. Now, that failed miserably because the same trader that decided what a great idea, let's go buy 10-year notes or 30-year notes or 5-year notes or whatever instrument they're using, and not hedge it against exposure to an interest rate rise. What then happened? Well, as we already know, the Federal Reserve has gone through the largest increases over time that we've seen in the last 50 years. So what does it really kind of lay down to me? Is that if you really want to find out what's going on, you've got to back out your history. You've got to really start looking at why all of this is occurring. And for that to really take place, you're really going to have to go back prior to 2008, 2009. You're going to have to go further back to see how and what caused the late 70s rise and rise in interest rates, which peaked in 1981. Everybody wants to really talk about well, there's a different set of circumstances it is now. It's like, yes, I agree it is. And the biggest one is that there's a ton more money in the monetary systems than there was back then. So what we want to maybe say that a 5% interest rate today in 2023 may be equivalent to a 15% interest rate in 1980. That may be if all things taken into consideration, but it doesn't belittle or reduce that what's going on now is that much worse because there's much additional capital floating around out there that needs to be removed. That still remains a big problem. There are $2.1 trillion, as I said, at risk. Profit and loss risk within the banking sector. How much of that falls to the regional banks versus the too big to fail banks is yet to be really revealed. We know there's a lot of risk on the regional banking level. And that's now being played out as we see they continue to come into PacWest. They continue to come in to Western Alliance. They continue to come into Zion, a lot of the regional banks, and they start hitting them. They start selling them. They pump it back up. They start shorting it again. The underlying problem has not gone away. But mind you, that even when, let's just put it this way, before First Republic actually went down, they came out and pumped the market with stellar earnings, causing this big rally in the stock, only to within a week or two drop 99%. That, folks, is unforgivable in my book. So that's why the SEC is going to go take a look at insider trading. What were those sales? And what were they really based on? And fair is fair. They should. But something should have happened way before this. So the stress test that's given by the Federal Reserve and the Treasury to determine the health of the banking system, that's really what failed. So again, our own system that created the problems, like the Federal Reserve, holding interest rates low, a ZIRP, they call it, zero interest rate policy, for decades. That is at the core of the problem. They didn't know when to turn off the spigot. They didn't know when to stop. And we went from catastrophe to catastrophe. We had the meltdown from the mortgages in 2008, 2009, caused a financial collapse. Only way out of that you got to pump up and refund all of the corporations that have now just suffered, right? Because we have to keep them, keeping their employees employed, and they have to be able to pay them, or everything goes. We go right off that glacier, right off that hill, right off that cliff, straight into what we don't even want to consider. Then we get all that going, and we have this fantastic rally. They hold the interest rates lower, continue to auction debt at unbelievably low rates. And then the banks able to take that and then charge us exorbitant rates on the loans, on credit cards, et cetera, that they continue to feed. You want more credit? Here, you got more credit. So now we see this catastrophe building all along, and then everybody's now back on top, and we're all living the high life again. Then we get the pandemic. Boom, smack, bam. Shut down the country, shut down the globe. Federal Reserve, Treasury, we've got to step in again. We've now got to create more money. We got to push it back out there, because now we have to fund everybody, because nobody can go to work. Now we got to make these big adjustments. That's another 8-point-some-odd trillion dollars that gets pumped into the system. And we see once again Wall Street just kind of go through the roof. Because what happened? People that really didn't need those stimulus checks got them anyway and put it in the market. So it's just sloshing around. Now we get into this banking crisis. Silicon Valley Bank goes down. Key Signature Bank goes down. First couple of threatens and that is going to go down. Eventually it did. But the first two, $400 billion got pushed immediately, almost overnight. Don't worry, we're going to secure all those deposits. Well, that's called stimulus. No matter how you want to look about it, they injected that capital into the system, into the monetary system. And guess what? It's still sloshing around out there. So, confusing? Yes. Now, let's take a second look. I've been talking about how we're in a primary B wave. All you need to do is pick up any one of the Elliott books, if you got the original writings of R.N. Elliott, and look at what is described in a B wave. A B wave, in my history, has been called a sucker play. Sucker, like, oh, you're a sucker for falling for that. In that we're going up or going down on kind of false pretenses, on not solid fact, on not solid economic data, on not anything. We're just doing it. And so it draws in. And now consider that this whole canvas of how things get reported is just tripled in speed because of the internet, because of instantaneous news. Instantaneous, you're there. And again, the increase in the size of the amount of money that is moving around in the market, it's gigantic. And if you need to really figure this one out, which will boggle your mind, just take a look at how many shares trade in some of these stocks. Take the average price of the day, times that number of shares. That's how much money traded there. Then add to that, in the derivative markets, the amount of money that's flipping around in the derivative markets every single day. And this is just the U.S. We have global involvement as well. There's tremendous, and I repeat, tremendous amounts of money still there. And people are using that as an excuse of why the market can't go down. There's just still too much money. So how can the Fed, or how can the government, how can the Treasury really start to clear up those balance sheets? Well, if higher interest rates really aren't going to work, what we got left? Debasing the currency. All right? Letting the currency drop. If you notice, and I will be going over that in the dollar index, that'll be my last one that I'll cover today. It starts to rally, but it can't get itself much past what I call par. Par is 100. It can't get over below, or really hold that strongly above 100. So it's presenting a quagmire into traders and hedge funds, portfolio managers, big trading firms that are using HFT. They're in and out every day. They make their money and they're done. But how do hedge funds, asset managers, macro traders, how are they going to position themselves? Macro traders, there's been a sincere absence of macro traders. And when we see them move in, it's because of something they absolutely have to do. Like lately, it's been they have to move money into tech. And I'll talk about that when I go over to the NASDAQ. Now, there's still a lot going on, but we're in a B wave. B waves go up or down a lot of times on misnomers, on a sucker play, on, oh, this is the belief. Oh, this is what has to happen. And we get that increase now because we have instantaneous information that is being presented to us as gospel, as truth, as absolute going to happen type reporting. It's the way it is. Take it all with a grain of salt, as we say. Remember that we need proof. We need factual proof, not just a hope, a whim, and a prayer that the banks truly are moving along at a good pace. That risk, that $2.1 trillion risk, profit and loss risk, so it's a risk of loss, is not going to happen. We have no clue because interest rates remain on a very fine, cracking piece of ice. What's going to happen? Well, we're not really getting a lot from the Fed, but we're getting a lot from pundits who tell us, well, this has to happen. The Fed has to do this. And let me tell you something. The interest rate cut, there is a possibility that they can do it. So everybody wants to now interpret, well, that means stocks got to go up. Think again. It does not mean stocks have to go up. Go and review what happens in recessions. Go and review what happens in periods of deflation. If we've just been dealing with a period of inflation, stock prices, whatever you want to call it, it's inflated. They have to deflate. That's just a natural process. Check it out. What happens in periods of deflations to interest rates, to interest-bearing products, et cetera, and see what happens. So we're sitting on the precipice of something. And then, therefore, I do look to Elliott Wave to kind of give me an insight as to, well, what is Elliott telling me? Okay, so back to that, Elliott, let's go back to the SPX. When I take a look at this, and we're inside of a B wave, a sucker play, a misnomer, unreal. It's going to go. And we still, not so much right now because of how everything's been counting out, but we've had for the longest time when I was talking about a B wave and a primary B wave, I was including the fact that it could have been an irregular B wave. And if that was the case, we'd be looking for the SPX to go above its highs of the beginning of January 2022 or 2023, excuse me. No, actually 2022. I was right to begin with. So, but I don't feel that is in existence anymore. So here we are in these finishing stages. Now let me bring this down. So we've got the A, and now we're looking for that B wave. The first fibs that you're going to see on here are support for what I think is coming next, and that's a primary C wave. But what I've gone and done is I'm looking at the support levels for this entire longer-term corrective process called supercycle wave 4. Now, again, I'm going to just review the breakdown. What's inside a supercycle fourth wave? 3 waves labeled ABC of cycle degree. What's inside of that? 3 waves labeled ABC of a primary degree, right? So in other words, we have ABC on a cycle degree. What's going to be in that cycle wave A? 3 waves labeled ABC of primary degree. Okay, What's going to be in that first primary A wave? ABC of intermediate degree. We got those done. We're now in that primary B. What's going to be inside of that? 3 waves of intermediate degree. A, B, and C. We're close to finishing those. What comes next? Primary wave C. What will be in that primary wave C? As we already know, all C waves are 5 waves. That means a 5-wave decline. And C waves are notorious. They're like third waves. That's their closest cousin, you could say, are third waves. Strong, very directional, destructive in terms of what can happen. If we're looking for a decline here, it will be kicked off. And again, everybody's saying I'm doom and gloom. I'm really not. I'm really not. There will be more trading opportunities inside that C wave than we can shake a stick at. You just have to be open and understand. You don't have to be married to a bullish or a bearish bias to go and play these markets. And you can make your money without having any bias or care what anybody else is doing. So it truly, truly does come down to each one of us in our own mindsets, and that's a different conversation, one I'd love to have. But when this thing kicks in, right now it is difficult to trade. Why? Because we're still inside this B wave. We're still inside this period of total indecision, total of we don't know what to do. We need more data. We need more points to go on. And every time we get more, they don't believe them. Well, no, we need more now. Well, because we got more going on. Now, I'm going to start bringing this down because I want to take a look at what's happening inside this thing. So let's take a quick peek inside. I'm going to bring this down quickly to the daily. Here inside the daily, here's the primary A. Here we have the intermediate A, intermediate B. We're inside that intermediate C wave. Well, my first thought remains, what does Elliott tell us? Well, most often we're looking for the C wave to take out the high, in this case, the high of wave A before it completes. Well, this high is 4,195. So it's actually 4,250 in the ES. But here in the cash market, we're still just 4,200. That's all we need, 4,200. And we got pretty dang close. We got up towards 4186, pushing towards that back at the beginning of May. And then we dropped. So what we're looking at here is continued weakness in the market, trying to balance out by getting up, balancing that strength. But now there's just too much, I hate to use the word, but I'm going to call it noise, inside the market about what the Fed has to do, what the Fed can do, what the Fed should do, what interest rates should do, what the market should do, what we think about a tech, how they're going to be this, how they're going to be that, as we see the different flows in and out of the different sectors. When you're considering that most of investors aren't just coming into individual stocks anymore, they don't have time to do all of that work, so they give their money into the ETFs. And so they then have to distribute and put it into different places and choose where the money's going to go inside their ETF. So, and their ETFs on everything. And all of them are pretty active. So while that continues to ebb and flow, we're still sitting not knowing what that larger move is going to be. So I'm going to rely again on Elliott. Elliott is not necessarily predictive on a day-to-day basis. It gives us thought. It allows me to give a two-sided picture. And you'll see that I try to do that on my Elliott wave updates, where I'm telling you the upside and the downside potential for the following day. Not necessarily the following week, but the following day. Now, in this big picture update, that's what I'm updating, the big picture. It hasn't changed. It's still suggesting we're going to be cresting, topping, and a primary B wave, which will then kick off and start a primary C wave down, which does promise to be more destructive, more quick in its moving, and consist of 5 waves, which we know are impulsive simply because of their nature. And the impulse will be down. I am not calling for the end of the world. I am not calling for a market crash. Those will be other people's words. I do believe there will be a bottom. And what I believe will come after this primary C wave is it will put in a low for a cycle degree A wave, setting the stage for a cycle degree B wave. But we're going to see this thing turn around once again. And I believe it will catch fire and it will be dynamic for trading. As much as I think that C wave down is going to be dynamic for trading. Stay open to it. Try not having an opinion. Don't trade with a bullish or bearish bias. I know a lot of us, it's just the way we are. We're not geared for anything else. Give it a try. By the way, you may choose coaching, and I offer coaching. And what I do inside there is work on people's mindsets, help people to develop their own trading plan, trading rules. And how do we keep a mindset in place when we're being bombarded by noise? Those are difficult things. I got to tell you, it's not the easiest thing in the world, but you can develop it. Okay, back to what I'm talking about. So here on the daily, we're still looking that, well, we're still holding. Our moving averages aren't really that bad. We're still in a position where we should go up, but we've been failing to do so. We find weakness, but then they rally back to that, what I might call the point of control. Weakness, and they rally back toward that midpoint, which just happens to be 41.25 to 41.50 in the SPX. Let's go down to that the 4-hour chart, and here, I don't need to do that. Let me go there. Just open it this way. You can see that we came down. We actually went down and we tested 4,100 on Friday, broke slightly below it, grabbed it back, and rallied up in the last hour to get ourselves back towards 41.25. Now, I want to add one additional thing that I'm catching a lot of grief about, but I got to tell you, when we think about it, it's going to behoove whether you're a swing trader, an option trader, or a futures trader to really pay attention and to try to learn about zero DTE options. Right now in the derivatives markets, zero DTE options across the board, right, are now, I think, over 50% of the daily options volume. These are the options that are being traded by large firms, large HFT firms, big institutions, and this is how they are doing several things. Hedging a larger position that they're keeping on, either bullish or bearish, that they're keeping on. But you're watching volatility swings intraday that can cause a large institution holding a position a lot of agony. Now, I'm not asking that we need to go down to the nitty gritty and understand somebody's pain threshold, but this is how they're dealing with it. And what this dealing with it does is produce these moves in our market where we can watch them sell it off, which they did on Friday, but it reaches a point and you see that change, and then they just start and buy it back. And what happens down here is they do what we call, they monetize a put, right? The put is the right to sell. Right? A call is the right to buy. So as markets go up and you've got a zero DTE option that's going to expire on that day at the close, you may be looking to monetize it before it actually expires. So you're out, you're done. Now, every single option as they trade in massive amounts, right? It has Greeks, what we call Greeks, and those are delta, gamma, theta, vega, rho, et cetera, et cetera. Each one has a meaning. The biggest one that gets traded against is the gamma, because that's what happens to the overall position as the index moves around. So gamma is effectively telling us all about premium. Premium is volatility. That's what volatility equates to, premium. Now, these options expire every day. So you're coming in at a level, but your premium, you'll notice, on the options, you just get your strike price and then place it against what the underlying is trading at. And you're going to get premium on each strike price. That then gets factored in, and now we got these gamma numbers, which either increase or decrease as things become at the money, out of the money, have no value. Well, gamma changes. And that then allows institutional traders to lift, put risk on, or put risk off. This is how it's trading now. I know it may sound complicated, and I don't think that we have to really grasp onto the finer details unless you're actually going to do that type of trading. I think it's more important that we learn, how does it affect the market? Because many of us that you're listening to me, we're in there trading every day, different vehicles. Maybe we're trading the Qs, maybe we're trading the spiders, maybe we're trading the ES, the SPX, the options in each of those. And so you're trying to make sense out of this, and how do I really get around, and how do I make money? Because let me tell you, there's been a big surge of investors, retail, that want to come in and grab a piece of that zero DTE option money. And they're losing huge amounts every day without, because you have to have an understanding what the functionality is and how that all comes to fruition. My question, or my premise, is learn about it before you jump in. Now, how is it affecting our market? Well, here we are in the 1 hour chart. Here's the bottom of 4. So I'm still looking for this minor fifth wave. Now, let me back it out, and we're just going to talk and just put in some of our basic Fibonacci levels to continue to show us, well, where should we kind of come in? And first I got to change this, and I'm going to put up my extension. So the first one I'm going to put up is for that wave C, which still is in force. So we got to look at that. There's the ticket, 42.43, because what do we want to do? We want to get, actually it's even lower, but we want to get above 41.98, 41.95. That is where wave C would exceed the high of wave A, which is a guideline, which is a pretty strong guideline that Elliott gave us. When you're looking for this formation, we're looking for wave C to create either a new high or low, depending on the direction of the structure. In this case, higher. We're looking for it to create a new high. Then we can attach Fibonacci to it that tells us, well, we've gotten up close. And what's our next level? Our next level is going to be 42.43 basis the Fibonacci for the C wave. As this starts to progress and continue, we do have additional levels. And a lot of those levels really do come in play for the futures market. This is where I've been keeping them, because one of the largest, so we're in this this fifth wave. And what should the fifth wave consist of? Well, 5 waves of minute degree. Well, we saw 1, 2, 3, 4, 5 come up to here. but it yet did not take out that high, didn't even get close. I mean, it sort of got close, but it didn't get close. So it would have been a huge failure. And even in terms of getting above wave A, an even bigger failure. So I have to go back and realize that this is very possibly minute wave 1 of minor wave 5. And all of this is minute wave 2. So what does that leave us? Well, we have a strong possibility that we still got a third, a fourth, and a fifth on the minute degrees. So what's that tell me? We still have 42, 43s realistically in the picture. It's technical, but I can't disqualify it. I can't say it's not going to happen. Now, mind you, if it goes up, it's a finishing move. It is not the start of a new bull market. It is not a continuation of a bull market that everybody wants to determine has come at the end of October. It is not. It's not. Bull markets don't start in the conditions that we are currently residing within. It just doesn't happen that way. Go back historically and look and read what was in play at the time. What was in play at the bottom at 2009? What was in play at the bottom in March of 2020? What was in play at the bottom in 1974 to 1978, depending on what point you wanted to put it at? What was occurring there? It wasn't instability in the banking sector. It wasn't, oh my God, what are we going to do? It wasn't fighting inflation and not winning. We didn't have the sincere threat of a $2.1 trillion loss within the banking sector, which in and of itself, folks, can still create havoc within the banking sector, overwhelming the Federal Reserve because they won't have this unlimited billions upon billions upon billions of dollars to flood the market to rescue depositors. So some will fail. Some will go by the wayside. And what happens? Panic. Now, you're either going to fall prey to the panic, or you're going to be able to stand in the storm in all of that chaos and pull out opportunity after opportunity after opportunity and make a bloody fortune. That's all I can tell you. Now, what can we start to look for here? Well, let's take a quick look at minor wave 1, which actually is pretty big. So minor wave 1, we got 40, 38, and I think, let me just get it right on there. And actually 40.39. And I'm going to go 0.50. And then the low of that is 38.05, 38.08.86. So I'm going to call it 40.39.50 minus 38.09. So we have 230 points, and that is minor wave 1. Is 230.50. Now, Elliott told us in his guidelines that when we're looking at a minor fifth wave within a 5-wave structure, the most common is that minor 5 will be equal. So we have the equality will be equal to minor wave 1. Well, we add 230. Here we have it. And that low is 40.28. And I'm just going to round it off. So these are going to be approximate. Actually, I can. 25. We're going to call it 25. We're going to try to be as accurate as we can. And we're going to add 230.50. So now we have 42.31. Bing. Look what this comes in. So we have that minor 5 will equal minor 1 at 42.31. You can draw a line. You can call it resistance. But at number 1, it clears wave A, so wave C, wow, beautiful. But now the market's having a lot of trouble putting in a decent rally. But there's your first number. So what we have, I'm just going to write this down. minus 5 equals 42.3175. And then we have that the second one, again, taking 230.50, is that minor 5 will be 0.618 times the length, and that's 142.45. So again, we come back down to this low, and that is, again, 40.4825. So we use it, 40.48.25. And then, just forgot my numbers. You please forgive me. 230.50 times 0.618 is 142.45. Boy, this didn't work, did it? Time 0.618. There you go. It's 142.45. So it's 142.45 plus we have that at 38.39. And that's 39 wrong again. Jeez, Michael. I'm not really doing all that great, am I? So 145 plus 38.08. Come on. 38. I'm trying to use a calculator and I'm not doing very well. 145 plus 38.08 is 39.53. That's not coming in right. So that one's wrong. That one's not going to happen at all. So we actually have to add it to this one. So I'm doing it wrong. 145 plus 40.49. And that's 41.94. Now we've gotten close. That would take us up to equal. There. I didn't realize I was doing wrong. Thank you. Early morning for me here, by the way. And that would just take us up to 41.94. The last one that we have is that minor wave 5 would be equal to 1.618 times the length of 1. And that would be, so we got 230.50 times 1.618, and that's going to equal 373 points. I'm going to say 373 plus 40, that low, come on, give me that low, right there, is 40.48, 40.48, and that's 44.21. That's way up there. Can the market do it? Well, technically, we have to include it. Technically, we have to include it. Is that what I'm expecting? They're having trouble getting it just above wave 3, let alone anything. So what I have are those two levels, is that this would be 44.21. These are all SPX. We've already given the numbers in the S&P. And those would be those numbers. Now, I also include additional levels in my comparison to wave 5 to wave 3. Oh, let me just show you one nifty little trick that is actually the quick way. I did them all by hand so that you know exactly how this all works, but you can put them in by using the extensions. We go to here, we go to the top of wave 1, and we bring it over to the bottom of wave 4. Now we have them. And you can see we have 42.31, 42.43, 100% is 42.81. So that's our zone. How this market is going to get there. Now, leaving all those in place, I'm going to bring it back down here. Now, if I mark this wave 1 and this wave 2, doesn't it make more sense? So sincerely, what we're now looking at is the possibility that the S&P or the markets are going to catch fire next week and start to move higher and get themselves back above 41.90. Get us up towards 41.92. Get us up into that zone where we have all of this resistance laid out, right? We got the 100 up here at 42.81. We have the 618 of the larger C wave at 42.43. Then we start with the minor 5, 42.31, 42.12, 41.92. Mind you, we're only looking, the A wave is just below 4,200. 42.12 definitely comes into play. Is it possible that the market can get up 80 points from here? I would say yes, it is a possibility. It's not up to me to make it a reality. The market will tell us that, but it is possible. Now, again, what can I do? Indeed, if wave 2 did complete here, let's just throw another layer on this thing. Again, this is all basis the cash market. And we're going to bring it back down to here. Now we have another layer. And where's it lining up? 42.05. Wow, here we are at the 42.05. Perfect level. 42. And that could this is just for third waves. And then a 4 and a 5. These are just so we have the potential there. Our Fibonacci relationships are telling us that. The market is stuck for good reason. It doesn't know what to do. What can overpower this week? That everything kind of takes a back seat. For whatever reason, we start to relax. Zero DTE options start to push again towards 41.50 or higher. Those come into play. That's where the market will go. Trust me, it's going to go. And have nothing to do with anything but just how options and volatility are trading. These are the new givens. These are the new facts. And they really do have a place in how we trade. And so they really do help put a lot of confusion. So again, if we continue to see, maybe we get the bond market, the Treasuries to rally, giving more thoughts on interest rates coming back down, and we get a bigger rise in the market. Remember, we're in a completing phase. We're looking for this thing. Please just rally yourself up there in a last gasp, a last hope, whatever you want to put around it. I'm going to take it day by day. I'm going to look for the signals, and I'll go long, but I'm a day trader. I have my own trade rules that protect me and that allow me to make profits no matter what the market does. But even if you're a swing trader, you still should have trade rules and then put them in and use them. It's when you break your rules, your own rules, that you get yourself in trouble. So there's a lot of things. Again, I provide coaching on all of this, and it's not easy. It's not easy because you're dealing with money. Okay, so here's what we're putting together for the SPX. We still have a few more upside moves to complete minor wave 5, and in turn, intermediate wave C, and in turn, primary wave B. So the countertrend rally remains in effect. Okay, and so moving averages, like I said before, they're not really getting too negative. They're all, look at the cluster. Let me see if I can open this up even more. We got this cluster. Oops, that didn't work. Let's try that one again. Oh, you can see the 50 flat as a pancake, the 20 flat as a pancake, the 200 flat as a pancake. 4 and an 8, they're going up. So we, even with that rally, flat, 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 flat. So let's go over to the NDX. Took a long time on that S&P. And so I'm going to back this out. Let's go back out to the daily. Same deal. Except here we have in the NASDAQ, it is going up and putting in additional new highs. It has, wave C has cleared wave A. And within its fifth wave up, it's kind of suggesting that it's producing a diagonal triangle. And within that, it looks like we may be in that finishing mode. So let's start to build what resistance we're going to have. So just quick in the NASI, want to just say, it is still in the process of completing an intermediate C wave to finish that primary B. The count still suggests a primary C wave down, which again, here I put in these initial downside, that just goes to show my support levels and what I've connected. I will take you out there real quick and show you. I connected the low of cycle wave 2 back in 1988, 87 to the high of cycle 5. That's the best I can do on my long-term picture right here. And that's what I'm going to be using. So here you have it. And as you can see, that's a major low. That's 126 in the NASDAQ cash market. The high is 16,764, 65 you can call it, was the high in the cash market. That's a lot to correct. But guess, look at this. All of our fibs for corrections holds above 5,000. There we go. Wow, 5,000. That's a major move. Yeah, it is. But it's going to be a lot of opportunity on the way down, and it still is above the 2,000 highs just before the dot-com bust almost busted the NASDAQ. It's still well above those. And that then tends to kind of give me a little bit of insight that even with the expected decline, asset managers, portfolio managers, people that have to shift and move money around for their customers or clients are still performing, or they're better, they're leading to continue to invest in the larger tech titans, as I call them, that the belief is going to turn to that even if we go into a recession, even if we go into a period of deflation, that it will be tech that continues to lead us in stability, you might want to call it, or just a portfolio that's a little bit heavier weighted in tech will do better overall against, say, for example, the S&P, against, say, for example, the Dow, or a lot of the ETFs. So therefore, you're going to see a lot of money being put into those stocks. And quite often, it's just prior to a major collapse. But it's not that they're wrong or they're silly or whatever. It's just how you do it when you're a portfolio manager or a hedge fund manager, asset manager, and you've got to position yourself for a potential strong downside move. So that all remains in play. So the preference is going to be that during the next expected decline over the mid to long term, these tech stocks will perform better than the averages. So that's that gig. So not all, right? So here we have all of our support coming off. Right now, primary wave C, well, I'm kind of looking like it should come down to 10,400 or probably even 10,000. So yes, folks, in the NASDAQ, I am revising that initial number. And that's just primary C. I'm not dragging this out to like to the cycle level yet. Cycle wave A or cycle wave C, yes. Yes, we're looking at these lower levels. We're looking at a market that should then drop 84, 64. That's what we're looking at. But that's further out down. And it's going to have a whole set of different circumstances. And we'll deal with that when that occurs. But right now, I would say we bottomed somewhere around 10,000 to 10,400. We will be able to put much more definition around it once it begins, once we get a top and we can start calculating for lower. Now, let me come back down here quickly to this market and come out to the 4 hour so I can say the 4. Now here again, here we have, I think this is the one I used, 12,086. And we're going to go to that low, which was 11,695. So we have 391. Minor one is 391. It's 391 points. So we're going to go, and if we're going to use minor wave 4 as where we're going to place all of ours. So the first one is equality. So we have that low is 12,724, 12,724 plus 391. That's 13,115. That's already gone right through it. Let me do that one again. Yeah. So that equality surpassed. So now we're going to go 0.618 is not going to work either. So we have 391 times 1.618 plus 12,724. And that is 13,356. We've gotten up to 41. Do you see how close we are? Now, I've also added some additional, and we're going to do that right now as well. So we have that 12,356 number, 13,356. And I'm going to round it up to 357. That's important. We're going to keep that one in mind. Because we've actually, no, I take it back. We've gotten over 13,400. So even that one's now out. So we're going to go to what's up going to be next. And I got to put these in. We're going to put this in right there. So you can see what we have coming up. We have 13,613 in terms of the C wave. Now, inside this thing, and I come back down to the hourly chart, we need to take a look at, as it gets very difficult, because this is minor 4. And I can put one more fib on in terms of looking at minor wave 2, which has to come in all the way down here. And here we have a double, 13,498, and then we have here 13,613. I had different levels, but those are in the futures market, and this is the cash market. So it continues to roll itself around 13,455, I believe. Here we have 415. So again, we need to take some of this off so that I can see, because what we got left is about here is where I'm counting. This is the 4. That's 1, 2, 3, or, got it up here. ABC 4. And if that's the case, we're doing a 3-wave up. And we'd be looking at 13,434, 35. Up towards that 516 number. And that's more in the future than it is in the cash. If I had to use the cash, it's going to come in a little bit lower. 67 in the NASDAQ, close at 4. There's still about 20. So we're looking at that 13,490, 480. So, and to tell you the truth, pretty much these should continue to hold. And this one, I can actually refine by removing it and putting in a new one, which connects 2 to 4, if indeed this is going to be the end of the move. So it was deeper, but not breaking any rules, still holding to, 3s, 3, 3. I know we should do a 3 and come back up. Now, here's the kicker. We can exceed that, get up to here, but it's going to be really strange, which it was last week as well, with the NASDAQ powering higher and the Dow, the Russell, and the S&P going lower. So either that's kind of reverse or the NASDAQ takes a day off while the others catch up. So it's a kind of a strange picture in terms of the markets being in unison with one another in terms of buying and selling. That may continue. So that's going to be, excuse me, our equity markets. I need to quickly move because I promised to try to keep this a little bit shorter. I want to go over the 30-year bond. 30-year bond is continuing to present a little bit of a weird pattern. Now, again, I am looking for this for next week, because I'm going to start here on, let me pull this open and we'll look at the daily. On the daily chart, the bonds, again, on an Elliott basis, coming off of the bond price high, rate low, which was in 2020, they've done 3 waves down, and this is all part of a minor 4, which I will consider complete at the recent 134.14 high in the 30-year bond. And that was back at the beginning of April. Out of that, we should do 5 waves down of minute degree to put in the minor 5th wave. And then that sets the stage. That sets the stage for all this noise that we're getting about interest rates and how they will have to go down, and likely will, while the markets go down with them. Whole different set of givens and rules going to be at play there. But how can that happen when we're just kind of sitting, we're doing nothing, but yet it looks like we're heading to break down? So what that means very short term is that rates will go up. Rates will move higher while the market fluctuates between moving higher and starting to move lower. So what I am looking for here right now is, this is my daily. So I've got the wave 4, and this is now the start of 5 waves of minute degree, of which we have minute 1 in place. Bringing this back down to the 4-hour chart, minute wave 1 in place. Minute wave C is actually just sideways action. Total indecision on the interest rate market. They don't know which way to go, but it's remained pretty volatile. The 30-year bond is remaining very volatile at the moment in terms of zipping up and zipping down and how much ground it covers very quickly. So if I got a minute wave 1, A, B, C, 3 waves down, X produces another A, B. I'm looking for the bond market to initially rally. And what are the markers now? What do we got going on here? Let me just continue to put this higher and then bring the whole thing down so we can see it. What I got going on is that we can rally up. Here's our resistance points: 3105, 3117, 3128, 3206, 3213, 3220. Ultimately, likely in a C wave, at least breaking above that 133. And now I have the resistance to complete at 133.07. Not going above this 134.14 high. That stays in place. And then it turns and we do another nosedive lower in a 3rd wave. And look what the first one looked like. The volatility has been very intense. So we get up here and then we turn and we drop. So there will be something, I think, that comes out that's just going to upset our markets. And interest rates will come, tumbling back down. Now, I have a larger, on the big picture, where we can come out and we look, and we use the same Elliott, by the way. What I have is I got to go all the way back. Got to go all the way back. And I'm talking about that we are in the bonds, in the 30-year bond. And now I got to compare minor wave 5. And what's my comparison? Minor wave 1. And actually, I think I can do it off of this chart. Minor wave 1. Bing, 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 down to there. So minor wave 1 is equal to 30.92. 30.92. So now I got something to work with now. I can come over here and I can go from there, and 30.92. So what that's going to suggest is minor wave 5, the equality puts the 30-year bond down way down here at 103.22. So that number 21, it just shows, and it's telling you that's how deep this market could drop it. I'm not looking for that right now, to be honest with you. What does fit is 5 equals 0.618 of wave 1. That gets us down to that one below 117, which is the wave 3, and to 115. 115.15 to 115.04. Put in a wave 5, setting the stage for a strong bond price rally rate decrease. Notice the connection. We need to go down before we go back up, and those rates will decrease. Why is the market having so much trouble here? Indecisive? Do we go up? Do we go down? Do we break out? Do we break down? They don't have enough information as to exactly what the time frame is going to be. Are we going to go through a few more interest rate hikes by the Fed to tackle inflation? Or, oh, gee, but you see inflation on the CPI, that looked pretty good. We've got all this adjustment going on. I want you to be very leery of those numbers. Those numbers are year over year. So they looked at March of 2022 versus March of 2023. Or April of 2022 versus April of 2023. Anybody care to go back and take a look at what April of 2022 looked like? They were nosediving. So yes, inflation improved year over year. I don't know how they came up with that calculation or why they even use it, but that's the one that everybody's going to hang their hat on. We were in the throes of a huge decline in Treasuries in April of 2023. We were in a huge decline. I'm just going to go one more out. Can't even. I got to go further. We were finishing a third wave down. I'm going to go out to the weekly. Here we are. March, April. Look out below. That's what they're comparing this past April. Of course, it does look better. Look where we were here. Look where we were here. So the numbers they're going to reflect it. I think it's a flawed model myself. Again, compared to what you're paying, and as a consumer, what we pay. Now, what are they basing it on? A month where we really saw inflation just jump a great deal, and as evidenced by both the markets. Okay, so that is the 30-year bond. I'm looking for a rally and then an additional decline. And that decline coming in a fifth wave should be quick, swift, and to the point. So that's what I'm looking for there. Quickly over to the 2-year note, which is the other one. So a lot of it's comparing the 2 and the 10. 10's in total confusion right now, by the way. It's even stuck in a stronger range, which I believe will yield one more little rally, and then it also will, I think, come flying down to put in its low. Now here in the 2-year note, if I take this out to the daily, you can see that it already did come down and put a -5 in an intermediate wave A. That's already done. It's done its first 5 down, and now we're inside of a B wave. But again, what we've done is we've done minor A. So what's going to be in this B wave, which is heading up, countertrend? It's going to be A, B, C. So we're still within this B wave, which is taking its time moving sideways. Again, indecision. Well-founded. What do? Do we really kind of start to climb again, or do we drop? It looks like, I think that we drop pretty quickly, bringing it back down towards 102.065. Put in a C wave, right? So we got a 1, 2. That's on the daily chart. Let me break it down to the hourly. We got a 1. Right, so we got 1, 2, 1, maybe a 2, and here's where we're going to end up. Actually, down a little bit lower. Here, closer to here. So we got to get 5 in. Then Let me bring it back out. What we're really looking at is an ABC. That's going to be the B wave. Then we get a decent rally up, which again takes above that 104 high that we saw in March. And that then would be the B wave. And then once again, folks, we're going to be looking at some pretty serious interest rate hikes. That's what the wave pattern is telling me, but that's out there, out there. It's not going to happen next week. It's not going to happen next month. It's out there. We got a lot to go for, and then we still have a C wave up, B wave finishing down, a C wave up. And once we're back likely out to these lofty levels, then we have a major decline. And that, I believe, will coincide with a much larger decline in our equity markets. And that's still out there, yet to come. All right, I'm going to continue very quickly here now. And I want to go over and just talk a little bit about gold and silver. Not easy wave patterns, but I believe we're subdividing, and we're just going to continue to explode higher. But gold is getting itself all caught up in its own moves, trying to reflect against what or how things should be trading, because our biggest deterrent from any rally in gold is if the dollar strengthens. If the dollar strengthens, we're selling gold. The gold prices will be sold. And when the dollar loses ground, right, a weak dollar pushes the price of gold higher. Other factor that remains in play right now and basically comes in early, it'll start during the European session and carry over into the beginning of our RTH sessions here in gold, and that is central bank buying. They're continuing to see central bank buying, and that remains strong. And it helped us spike at the beginning of May up to that 2085 level, I think it was. Yeah, 2085. Now we come all the way back down, touch almost 2000. So whether we're actually done with this, this is minute, this is minuet, this is sub, again, 1, 2. It's actually come down and equal. We might see a little bit lower. I'm not looking for it to really go below this, but it might come down and test 2000, or it just turns and starts to take off and then finally get itself above there. So gold remains, I think, in a positive stance, but not easy to trade. If you're a day trader, it's producing a lot of opportunity, but you got to be quick on your feet, and you've got to really have good, solid trade rules, and always work with a stop in gold. The reversals, the turns can be vicious and move suddenly. And I'm talking, at a buck, 10 cents. So a tick is 10 cents in gold. That's $10. So each tick is $10. So each dollar is $100. And gold will flip, say, for example, between 2015 and 2020, like zippity-doo-dah. You got a $500 trade against you or with you. So it can move very, very quickly. Silver also. Now, silver did start to play catch-up, and we saw silver get all the way back up above 26. That, I believe, completed a minute wave 1. And then we got this, whoa, get out of the water. And that is very indicative of a second wave. Second waves can be just a sudden reversal, boom, and that's what we got. So we put up some fibs to give us a little covers to where we can come down to. This was actually for the rally back up. If I take these out and I go over and just put in fibs for this decline, we're going to be covering wave 1, right? We've just actually hovering around 0.382, more common, 50 to 618. That's 23.30 to 22.50. And I can do it and then start to rally again. A little bit cleaner here in silver than it is in gold, but we were looking for gold to pick up the pace and get itself above 25. It did, but you see its comfort zone is not 25. The comfort zone is 24 to 23 right now, and maybe even a little bit lower, but we'll see. So I'm looking for a little bit lower in silver and then an additional rally to pick up. Whether it gets there all the way or stops here and rallies again, it depends on what the market does. And lastly, today, I want to take a look at the dollar index. And the dollar index, as stubborn as it is, so basically what I'm saying, the dollar index is as confused as the markets. You can see they did a nice rally, but they managed to close it so it would close in a red bar. And actually, this is the daily and closed. Look at that. Like negative, negative. And I'd be thinking, we're not going to go up. So we remain in that position. I'm leaving my labeling as is, an A, B. If anything, if the rally does pick up and continue, then maybe we will get that A, B, and we'll get a C. But it's at this stage, it's very likely just going to be a flat. So the A, the B equal in length, the C wave should also equal it. So we're really not looking for much more than just a rally back towards 106, which seems like an eternity from where we are. And then we begin a much larger decline in the dollar. And that would be in the terms of a minor C wave, and this was minor A. So if we get a flat here and you're looking for something that's going to be that big, that's going to be, 14, 15, somewhere around there. And it's going to start from here. You're looking at well below par and somewhere down around 95, 96. So, yeah, somewhere down in here for the C wave. Now, what did that do for gold? Well, get out of the pool. It's going to rally like you wouldn't believe. What's that going to do for the bond market? What's that going to do for equities? We shall see. Right? We shall see. I'm going to finish it all right there. I want to thank you for listening with me today. I know the bulk is also always spent in the SPX and the NDX. Hopefully you picked up something in the bonds. If you need more information, please feel free to ask. I will do my best to put a little bit more detail if you ask. And for the balance, I will make another quick Elliott wave update. Those will be just confined to the futures market. So again, I'll wait for Globex to open this evening, and then we'll be covering the ES, the NQ, and very likely the 30-year bond. For the balance, have a great Mother's Day. Happy Mother's Day to all the moms. Have a great Mother's Day, and our next update will be the Elliott Wave update this afternoon.